If you have a health savings account, commonly shortened to HSA, you have got to understand when you can contribute, how much you are allowed to contribute, and then when you and your employer need to stop contributions to avoid penalties and fees. It is not uncommon for HR teams, CPAs, and Medicare advisors to get these details wrong, so let's clear things up by going over when you can contribute to an HSA. I'm trying out this new black drawing board. Let's see how this goes. You must be covered by an HSA eligible health insurance plan to contribute to an HSA without penalties. These health plans are referred to as Qualified High Deductible Health Plans, or QHDHPs. Employers offer these. The ACA Marketplace also offers these. Both employers and the marketplace also have non-qualified plans, so if you want to make HSA contributions, make sure that you are covered by an HSA-eligible health insurance plan. Your employer would be able to tell you whether the plan that you are on is or is not. Speak with your HR benefits manager. Marketplace plans actually have a search filter where you can show plans that are HSA eligible as you're looking for plans, or they will indicate it once you get the plan. This is not me telling you that you should get an HSA eligible plan for your health insurance coverage. They are not a great fit for everybody, but if they are a fit for you, you need to be covered by one to make HSA contributions. If you are not covered by an HSA eligible plan, neither you nor your employer can add money to your HSA. Don't do it, otherwise you will be penalized, and I'll get to the penalties later in this video. Where things get a little cloudy is if you are covered by an HSA eligible plan for part of the year. Maybe you or your spouse switched jobs and then you went from not having an eligible plan for part of the year to now you do. Or you were on a qualified plan for part of the year, but something like Medicare came up and messed things up. These situations will affect not only when you can contribute, but how much you can contribute. And this is the point in our conversation when we need to introduce the term prorated. To know how much you can contribute, you need to prorate your contributions based on the number of months that you were covered by an HSA eligible health plan. Let's say that I was covered by an eligible plan from January through the end of June. That means that I was covered for 6 out of 12 months of the year. And this means that we can make the prorated contributions to the tune of 6/12 of the maximum contribution for that year. Our math majors are going to want me to reduce that fraction to 1/2, but I'm not going to do it. That amount that you can contribute, the 6/12 in this example, is the total amount you and your employer can contribute combined. It is not an opportunity to try and cheat the system where you contribute that amount and then your employer also contributes that amount. It doesn't work like that. Now, the reason I'm not reducing that fraction is because let's add another month where you were HSA eligible, so you had a qualified plan through July now. This means that you can make 7/12 of whichever the contribution maximum applies to you in that year. So you can contribute a fraction of the max contribution limit in the year based on the number of months that you were covered by an HSA eligible plan. However, there is one strange exception, and that is if you start your HSA eligible plan on December 1st. There is a way that you can get the full year's worth of HSA contributions. This is known as the last month rule or the full contribution rule. In order for this to happen, meaning you can contribute the full maximum amount to your HSA for that same year when you go on in December, you must be enrolled in an HSA eligible health plan as of December 1st, and you must remain in an HSA eligible plan through the end of the following year to avoid penalties. So don't try this strategy if you think that you'll be coming off of an HSA eligible plan at any time in that next year. If you violate the testing period requirement, your ineligible contributions become taxable income and you'll face a 10% penalty. There are two other main situations that will impact how much you can contribute to an HSA. The first variable involves how many people are covered by the HSA eligible plan, and the second involves your age. Let's start with how many people are covered by the HSA eligible plan. There are two maximum limit numbers that apply every year: single and family. As of the making of this video for 2025, the single limit is $4,300. The family limit is $8,550. You can make contributions of any number up to this number. You just can't go over the number except in certain age situations that are coming up in the next section. Now, single can mean your relationship status. If you are single with no dependents, the single limit is your maximum contribution. Again, your contributions and any other employer contributions combined cannot exceed the single maximum amount. But single does not have to be your relationship status. Single is referring to how many people in your immediate family are covered by a high deductible health plan. As an example, if I work for a company that offers an HSA eligible health plan and it covers just me, but my wife works for a different company that has a non-HSA eligible plan, and she and the kids are on that plan, we can only contribute the single limit. However, if I bring just one of those kids onto my plan, now we have 2 people covered by an HSA eligible plan, and I can make the family max contribution. So the family designation is referring to the number of people covered by the HSA eligible health plan. If you and your spouse are divorced, same thing applies here. If you have yourself and one other dependent on your qualified high deductible health plan, then you can still make the family max contribution. To continue this idea, now my spouse and I are working for separate companies. We are both covered by separate health insurance plans, and each of us has one kid on each of our health plans, and both plans are HSA eligible. Well, now we introduce the idea that HSAs are always personal accounts owned by one person. She can open her own HSA. I can have my own HSA. She and her employer can contribute to her HSA. My employer and I can contribute to my HSA. Our limits are both technically the single limits, even with a dependent on each plan, because combined we cannot exceed the family max. She cannot contribute the family max into hers, and then I contribute the family max into mine to try and cheat the system, doubling our allowable contributions. I've mentioned it already, and this is another opportunity. Don't try to cheat the system. Likewise, she can't make the family max and I get the single max to get $12,850. It doesn't work like that. Now, married couples could maintain just one HSA in one of the spouse's names, but the HSA accounts are individual accounts. Mine is mine, hers is hers. If we decide to use my HSA and she doesn't want to get her own, her employer cannot contribute to my HSA. We can still make the family max contributions, but because it's my HSA, my employer can contribute, hers cannot. This means that we could potentially miss out on free money from her employer if they were offering HSA dollars if we are just maintaining one HSA that is mine. So having one HSA may be easier to keep track of, but there's another reason why keeping them separate can help you max out your HSA contributions in a different way, and that transitions us to the next variable, your age. Once you reach 55 years old, you have what is called a catch-up contribution that you are able to make. Anyone covered by an HSA eligible plan now gets an additional $1,000 in catch-up contributions that he or she can make for the year. That's every year past 55 as well. So it's 56, you get another $1,000 catch-up you could make, and then again at 57, and on and on and on. That is not 1,000 added to another. So you don't get 2,000 at 56, 3,000 at 57. It's $1,000 per year that you are above 55. Here's how having separate HSA accounts is a way to get even more money in these accounts. In this new scenario, my spouse and I are covered by my work plan, which is an HSA eligible plan. I'm the only one with an HSA account. My spouse and I are both 55 or older. We get to make the family max contribution number of $8,550 in 2025. Because I own the HSA, I can make $1,000 in catch-up contributions, bringing our total amount to $9,550 for the year. Since she does not have her own HSA, I do not get to make the $1,000 catch-up contribution into my HSA on her behalf. It doesn't work like that. But if she opened her own HSA account, and she can, even though she is a dependent on my work plan, if she has her own HSA account, she can now contribute her $1,000 catch-up contribution into her HSA, bringing our max for that year to $10,550 instead of the $9,550. So each of you having a separate HSA is not a bad thing if you're trying to max fund your HSA dollars. Catch-up contributions also follow that last month rule or full contribution rule. If you turn 55 in December, you can contribute the full catch-up contribution amount to your HSA for that same year. Again, you must be enrolled in an HSA eligible plan starting in December, and you must remain on that HSA eligible plan through the end of the following year to avoid penalties. Okay, we now know when we can contribute to an HSA. We know how much we can contribute to an HSA. Now we need to cover when we need to stop HSA contributions. This is a super easy conversation if you are not dealing with Medicare. Just stop your contributions when you are no longer covered by an HSA eligible plan. Use our prorating guidelines that we've mentioned based on the number of months in the year that you were covered by a qualified plan, and then multiply that by whichever contribution max applies to you, single or family, with your catch-up contributions. Here's a quick example. You and your spouse are covered by an HSA eligible plan from January through April 30th. Many people have their HR team set up automatic HSA contributions each month that equal those prorated monthly amounts for all 12 months. If you have these regular contributions set up, Your last contribution is in April. Stop contributions moving forward so that you don't have any coming out in May or after. Timing is important, but what is more important is the amount of your contributions. So if you don't have these automatic contributions that equal your monthly limits, you can make HSA contributions for a given year all the way up until your taxes are due. So you aren't getting penalized based off of when you contribute. You get penalized if you contribute more than your prorated maximum allowed amount. In our example here, you aren't penalized if you make a contribution in May, now that you are not covered. You are penalized if your contributions that happen in May send your total contributions for that year above the amount that you're allowed to contribute. I have people reach out all the time saying they've messed up. They've made a contribution to their HSA a month or two after they started Medicare, but their contribution amounts did not put them over their prorated max contribution amount. So they are okay. They don't need to do anything. Here's another tweak on that example. You and your spouse are covered by an HSA eligible plan from January through April. You are both 55 plus. You both have your own HSAs. You can contribute a prorated amount of the family max plus your $1,000 catch-up contribution to your HSA plus your spouse's prorated amount of the $1,000 catch-up contribution into your spouse's HSA. We need to figure out the prorated amount off of the family max plus our catch-up contributions, totaling $10,550. January, February, March, and April make 4 months that we were covered by a qualified plan and eligible to make contributions. The prorated amount is 4/12 of the $10,550, which is $3,516.67. For the 2025 tax year, you too can make a combined contribution amount of $3,516.67. It doesn't matter if you make all of that on January 1st of 2025 or up until you file your 2025 taxes, which if you are a high-level procrastinator, puts you at April 15th of 2026. So the amount is more important than the timing. This will come into play as we transition into the wrinkle in all of this, and that is for my friends who are going on Medicare. You get to deal with a little bit more complexity. Now, Medicare and HSAs have some of the most common myths and misunderstandings around them, especially among my HR and CPA friends. Neither you nor your employer are allowed to make HSA contributions once you go on Medicare. That is any part of Medicare. The myth or the misunderstanding that people hear is you have to take Medicare Part A when you reach 65 or you'll be penalized, or you have to take it and it's free so it's no big deal. This flat out is not true for those of you covered by a company health insurance plan. You do not have to take any part of Medicare at 65 if you plan on continuing to work past 65 as long as your company has 20 or more employees. And if you are on an HSA eligible plan and you are getting money from your employer put into there and you want to keep contributing to this HSA, you do not want to take Part A only, even though Part A is free to you. Because once you take Part A, you and your employer must stop contributing to your HSA. Otherwise, you will see penalties and excess contributions will need to be shown as taxable income. It gets even more tricky because Part A has an interesting 6-month backdating of its start date in certain situations. This gets messed up a lot. This is important. Here is the rule that makes this confusing, and this is coming directly from Medicare.gov, not me. So if you want to argue with it, argue with Medicare, not me. If you qualify for premium-free Part A, your Part A coverage starts the month you turn 65. If your birthday is on the 1st of the month, coverage starts the month before you turn 65. You can sign up for Part A at any time after you turn 65. Your Part A coverage starts 6 months back from when you sign up or when you apply for benefits from Social Security. Real quick to clarify here, you apply for Medicare benefits through the Social Security Administration, but Medicare and Social Security benefits are two separate things. We are not talking about the money that would come from Social Security benefits in that sentence, just applying for Medicare benefits through the government entity that is the Social Security Administration. Okay, the last sentence is so important. Medicare coverage can't start earlier than the month you turn 65. This is not referring to those who qualify for Medicare before 65. Let me break this down with some examples because as simple as that sounds, and maybe it doesn't sound super simple, but people get this messed up in a variety of ways. If you apply for Part A and you are coming up on your 65th birthday, so you want Part A to start when you turn 65, your Part A will start on the first day of your birthday month. Unless, if your birthday is the first day of the month, your Part A will start the month before your 65th birthday month. What does that mean for your HSA contributions? It means that if you are going on Medicare at your 65th birthday and your birthday is not the first of the month, The last month that you can make HSA contributions is 1 month before your 65th birthday, not 6 months back. If my birthday is in April, I can make HSA contributions all the way through March. If my birthday is the first of the month, so April 1st, that means that Part A will start on March 1st and my last contribution is in February. So the 6-month look back does not extend earlier than your 65th birthday month unless your birthday is the first day of the month, in which case it starts 1 month before your 65th birthday month. Now, what if you take Medicare at 65, but not during your 65th birthday month and only a few months after 65? Let's say it's at 65 and 4 months old. Again, using our April birthday, and let's say that it's April 15th. So I apply for Medicare 4 months later in August. The 6-month look back comes into play, but remember what Medicare.gov said. Coverage can't start earlier than the month you turn 65. This means that it won't be a full 6-month look back. It will be 4 months in this case because it will go back to your 65th birthday month. Medicare will begin on April 1st. Your last HSA contribution can be the month, 1 month, before your 65th birthday month, which is March in this example. Okay, the last example, what if you sign up for Medicare more than 6 months past your 65th birthday? I'm going to say that you're now 67 years old, so we are well away from our 65th birthday. Now the full 6-month look back comes into play, but 6 months back from what? Let's read what Medicare.gov says. Your Part A coverage starts 6 months back from when you sign up or when you apply for benefits from Social Security. It is saying 6 months back from when you apply for benefits, not 6 months back from when you start benefits. Let's go through this. Our advice to most people who are signing up for Medicare is to start the process about 90 days before you need Medicare to begin. If you want Medicare to start on April 1st, start the application process through the Social Security Administration sometime in January. Signing up for Medicare takes time and there can be delays on getting everything approved. So I'm 67 years old, past 65 at this point. I want Medicare to start in April and I sign up or apply for Medicare benefits in January to have them start in April. I learned that my Medicare Part B will start April 1st, just like I wanted, but my Medicare Part A start date will be 6 months back, not from April when Part B starts, but 6 months back from when I applied in January, putting my start date at July 1st of the previous year for Part A. If I have an HSA, that means that my employer's and my last month to contribute to my HSA is in June of the previous year. Much like we were talking about before, when you stop contributions can be important, but the prorated amount of your maximum contributions is more important. If your last contribution should have been in June, that means you get 6/12 of whatever your max contribution amount is for that year, and that amount is what you can contribute for the calendar year. Again, technically you can contribute to the HSA after June, but the amount has to stay within your allotted prorated amount based on June in this example. Spouses, I want to make this very clear. Remember how the HSA is an individual account. My HSA is my HSA, my wife's HSA is her HSA. If I'm working and my company is contributing to my HSA, but my wife goes on any part of Medicare, her Medicare eligibility does not affect my HSA status. Likewise, my Medicare status does not affect her HSA status. There are two separate ways to handle this. Assuming I'm not on Medicare, if my spouse goes on Medicare but stays covered on my company plan, that means that my plan is covering more than one person and I can continue to make the family max contributions to my HSA. She would not be able to make her $1,000 catch-up contribution if she has her own HSA, but I can make the family max plus my catch-up contribution. If she goes on Medicare and then drops off of my company insurance plan, so now it's just me on the plan and she's fully on Medicare, now only one person is covered by the company plan. This means that I can only make the single max contribution plus my $1,000 catch-up contribution. These limits continue to follow the prorated system we've outlined. Just one more example here. If my spouse goes on Medicare and drops off of my company plan mid-year, let's say it's in August, you take the number of months that you and your spouse were covered by the HSA eligible plan, in this case it's 8/12, calculate the fraction of the family max contribution you can make. So 8/12 multiplied by the family max plus my $1,000 catch-up contribution plus her $1,000 catch-up contribution if she has her own HSA. That 8/12 is multiplied by $10,550, which comes to $7,033.33. Then we take the number of months that I am by myself on this plan, which is September, October, November, and December, so 4 months, and multiply the single max plus my $1,000 catch-up contribution by 4/12. That would be $4,300 plus $1,000 for $5,300. Multiplied by 4/12 gives me $1,766.66. This brings our total contribution limits for the year to $8,800 instead of the full family max plus catch-up contributions of $10,550. Can you see why so many people get this stuff wrong? Can you also see why I think it's so important that you work with a Medicare agent who gets this stuff if you are coming off of an HSA plan? I get messages every week of mistakes that are being made here. So the 4 big mistakes to avoid with Medicare and HSAs are trying to front load your HSA and not understanding the prorated amounts, or thinking that the 6-month look-back period will go before your 65th birthday month and you stop contributing too early. Or you stop contributions while you are still eligible just because your spouse took Medicare and you didn't know that your spouse's Medicare status does not affect your HSA status. Or the 4th, if you are past 65 years old, not realizing that Part A backdates 6 months from when you apply for Medicare, not when you want Medicare to start. And if it crosses to the previous year, it's not uncommon for people to have already filed taxes with over contributions to their HSA, which are now subject to income tax and a penalty. Let's knock out the penalty real quick. How much is it and how do you avoid it if you've contributed too much? The IRS imposes a 6% excise tax on any excess accumulations in your HSA. This tax is applied every year until you withdraw the excess amount. If you have your HSA invested or gaining interest, that 6% tax applies to any gains or interest on those excess contributions as well. In addition to the penalty, one of the benefits of an HSA is the tax-free contributions going in. Well, excess contributions are not tax-free, so they count towards your taxable income in that year, and you are taxed according to your marginal tax rate. Here's how you can avoid penalties if you've over-contributed. Your HSA dollars are held in what is called a custodian. There are many custodians out there. Some of the bigger ones are Health Equity, Fidelity, HSA Bank, Optum Bank, and there are others. If you have over-contributed, you go to the custodian and you withdraw the excess contributions. When tax time comes around, that withdrawal amount will need to be shown as income for that year and taxed according to your personal tax rates. The last thing to understand with stopping your HSA contributions is that even though you have stopped contributing to your HSA, you can still use your HSA for qualified medical expenses. All of these timelines and rules are when you can no longer add to your HSA. They do not limit you on spending your HSA funds. However, there's always an exception. When we're talking about Medicare, HSA dollars can be used for your Part B premiums, your Part D premiums, co-pays, deductibles, co-insurance, dental and vision premiums, and any other qualified medical expense. However, Medicare supplement plan premiums do not count as qualified medical expenses. You cannot use your HSA dollars to pay for Medicare supplement plan premiums. This also goes for pre-Medicare plans. You generally cannot use your HSA dollars to pay for health insurance plan premiums. And let me clarify, you can use those dollars to pay for them, but they are now taxed, which eliminates one of the biggest benefits of an HSA. So if you want a Medicare supplement plan and you have an HSA, be aware of this rule. I think it's an absolutely silly rule, but they don't care what I think. Maybe if this channel got to a few million subscribers, they'd start to care what I think. All right, the last things that I'll clarify quickly in this video are flex spending accounts, also known as FSAs, and health reimbursement arrangements, or HRAs. If your company has some sort of a financial health account and you're not allowed to roll over your entire balance of unused dollars year over year, that means that you have an FSA or an HRA, not an HSA that this whole video is about. FSAs and HRAs do not carry over full balances year over year, and they do not follow the same Medicare rules as HSAs. Someone who is Medicare eligible can have an FSA or HRA, and they can contribute into their FSA or have their employer contribute into an HRA while on Medicare Parts A and or B, and if they're actively employed or they're retired. If you want more information on how FSAs and HRAs work, this video on our channel that looks like this goes over them in more detail. I'll link to it in the description of this video. Now, if you are new to this channel, welcome. If this was helpful, please consider subscribing so that the government will take my thoughts around allowing supplement plan premiums to count with HSA dollars more seriously. But I have a little tradition where I throw in a secret code word at the end of every video to make sure that people made it to the end. I get hundreds of comments a day and I try to respond to as many of them as I can. Sometimes these comments get a little bit mean and they say things like I'm misleading because I didn't cover the full story when they haven't watched the full video where I do cover exactly what they accuse me of not talking about. So if you leave a comment and include the word polka dot, then we will both know that you've made it this far. I can take those comments a little bit more seriously. If you want to know the 4 tips to maximize your HSA and turn it into your absolute favorite retirement account, check out this video right here. I appreciate you taking the time to watch and making it this far. I will see you over there.